Everything stands on top of the shoulders of the Fed. Don't worry, they'll take care of you. I mean, they stepped in during the drop in March 2020. They'll definitely do it again next time around, too. Sure, they can't lower interest rates any further. Or can they? You came here for the truth, so let me unveil that for you today. We are going to talk about the potential for another Archegos to take place. These hedge funds, family offices, other businesses that use different methods than you and I are able to simply skirt around any rules and regulations that are in place, and they can leverage up as far as the eye can see and beyond. Today we're going to talk about that. We're going to look at some other issues, even the Federal Reserve as well. You know how I love to talk about them, and I want to get into real estate and other things, so let's begin right away. Credit Suisse sells $2.3 billion of stocks tied to Archegos, and one of those is Viacom CBS, something that I covered in a previous video showing you the stock tanked. If I remember correctly, it was down about 50% in 5 days. Now, you as an individual, you're owning this stock. You think it's fantastic. It's growing from March 2020 and beyond. You're holding on to it. And then the stock drops in a matter of 5 days, 50%. What do you do? That's a question I pose to you as the investor. I'm not talking about Viacom CBS. I'm talking about any stock. Do you hold? Do you think, well, you know what? If it came down that far, it's got to have, an opportunity to buy that dip. But maybe you bought it here and maybe you bought it here and on the way down. And people generally are not prepared to have such a drastic drop in such a short period of time. You need to have an exit plan in any business, in any investment. Always have an exit plan prepared before you execute initially. That's my tip for you. If you have a few minutes, definitely watch this here. Scott Meinert from Guggenheim. He says another Archegos style blow up is, quote, highly likely. And that's basically the summary, okay? He mentions it very briefly in this interview on Bloomberg. Like I said, you should definitely watch it for yourself. But essentially saying that they don't know what's happening within these companies. There's a lot of secrecy. They can do basically whatever they want. And we have yet to find out about the ones that are going to blow up. So this is just one individual saying that, but I think it's pretty clear that we could definitely experience more of these. Now, whether or not that's going to trigger some sort of major event, I don't know, but at least we could see more of this. And he believes that as a result of what we saw with this and with GameStop and so on, that we're going to see more regulations in the financial system, as well as with SPACs, because they suggest that there will be certain level of performance, and then oftentimes they find that that isn't the case. There's still euphoria in the amount of money that's going in, but the actual returns are not keeping up with their promises. So he says that they think that they will regulate that. So we're going to come and have to see what happens in time. I showed this recently, wanted to give you this. It's an update out of Bank of America. They have their own, as they show you here, equity sentiment is at a 10-year high and in striking distance of a contrarian sell signal. So right here, they give you the breakdown. Essentially, we are approaching that point, which essentially when everyone is bullish, that's generally not a good time, because you often have the opposite happening. And this is indicators like, with the RSI, for instance, when it's overbought, when it's oversold, you can track that on a shorter term scale, give you some idea as to what's happening with the index or with a particular stock. But there's a lot more that goes into that. But essentially what you're seeing here is just one of many indicators that is absolutely flashing red. But here's the historical truth. This comes out of Real Investment Advice. April has been very kind to stocks. At the top, S&P 500, and you're looking at this, it breaks it down since it's hard to see that exactly. I think it's 1950 over the past 20 years, past 10 years. post-election years. In general, you're seeing this right here. It's basically noting that it happens to be a good month in general. So we are going to track it and see what happens, but there's too much at stake here to really just say this is one thing or another. I think with all the stimulus, with all the quantitative easing, it's probably at this point looking like, unless something does in fact blow up and start to unwind, derivatives start to unravel here, it looks like it'll probably head upwards or at least sideways. Down doesn't seem like it'll be an option because the Federal Reserve is going to come out, as we'll talk about more in a second, and pacify the markets. This comes out of Axios and basically just talking about the Federal Reserve and claiming that they took over the economy. And, I think it's a little bit more, there's more nuances to that. But anyway, to brace the U.S. economy and stave off another Great Depression, the Federal Reserve has taken control of it through unprecedented intervention, manipulating market prices, controlling rates, and propping up companies on a previously unimaginable scale. And they just go through talking about what they've done and their activities. If you kind of want a general overview, this is the article to check out. And the point I really want to make here is this. We've been through a period where low interest rates have not, and that's the key, have not stimulated the economy very much, and where disproportionately companies increased profits to go into automation, killing jobs, not creating jobs. At a zero interest rate, the cost you focus on is the cost of labor because that's your only cost. Whereas if the cost of capital goes up relative to the cost of labor, you get a more balanced kind of innovation and investment. Very good words there, very interesting, and I think people should, ponder that for a bit. But what's the solution? I've got it for you, and so does everybody's favorite Janet Yellen. That's right. Exclusive Janet Yellen to call for a global minimum tax rate. We don't want to race to the bottom. That's what she says. We don't want to race to the bottom in the tax rates. Let's all agree in the G20 to keep it all very high. And then, of course, it'll be higher the next year after and the next year after. That's the solution because, of course, you bring in a record amount of taxes every single year, and somehow the problems just keep getting worse. But yeah, sure, global minimum tax. Fed's Mr. Law's job report, but says loose policy is staying put. This is the message I have for you today, and probably talk about this more during the week. You're going to see the Federal Reserve coming out and making sure that everybody stays calm and, more importantly, invested. It was great to see that report. We need more of them coming our way because you've been seeing the jobs. Oh yes, it's so fantastic. However we want to look at it, jobs, more and more and more and more jobs, or the unemployment rate, the fake unemployment rate. Last time I checked, 6.2% on the U3 unemployment rate. It is nonsense, but this is what they're telling you. I'll talk more about this in just a second. The Chicago Fed president, Richmond Fed president, St. Louis Fed president, they are each slated to deliver public remarks later this week. Jerome Powell will speak at an IMF panel Thursday. And also you're going to get meeting minutes from the March FOMC. All of this together. And I think I got one here as well. I think it's important to look at all of this and realize what's happening. Okay? You're seeing this in a time in which the Federal Reserve has told everybody that the economy is far off from where they want it to be. At the same time, they point to the jobs reports. They point to the economy in certain areas saying that it's growing, it's growing, it's growing. Things are fantastic. But what we're going to do is we're going to continue to expand our balance sheet all the way to $10 trillion, and we're going to keep interest rates at a record low. We're also going to give money anywhere it's needed, and don't worry because interest rates won't be increased at least all the way through to 20%. past 2023. Now, if you don't see a problem with that, I mean, I don't know what's going on. These things do not match up. And my goodness, how unbelievable the way that the investor mentality has been switched. I just did a video, I believe the previous video I did, a horrible amount of views on it, by the way, nobody really cares. But what I talked about, actually it was 2 videos ago, how the investor psychology is distorted because of low interest rates. That's what happens. The whole video is basically focused around that. So if you haven't seen that already, it was 2 videos ago. Definitely check it out. This right here is just an article talking about the craziness in real estate. More than 40% of homes sold above the original asking price, an all-time high. Come on, 40% above? This is unbelievable what's happening. This is out of Fox New York, but you see it everywhere. You see it going on all over the place. Palm Beach County mansions scooped up in a hot market. You're looking at right now, 2021. I mean, these more recent times, everything is going parabolic, and it's not just one place or the other. I did a video where I had primary focus on Canada, primary focus on Toronto, but I could have made that many other cities. In fact, check this out. This article here specifically breaks it down. It's not just Toronto and Vancouver. Canada's housing bubble has gone national. And they talk about a small town where this particular person was not expecting their home to sell for, some fantastic price, but it did. There's so many bids on it. There's so many people buying into it. But I know, all of the people are just suddenly in search for homes. I get it. No. It's got nothing to do with the fact that we have investor euphoria and the fear of missing out and the speculators. Let's not talk about those. They don't exist anymore. They used to exist, but now, no. They don't exist anymore. Netflix lost 31% of market share in the last year as streaming rivals gained ground. I think it's interesting to see what's happening with Netflix. I mean, they've dealt with a few issues definitely over the last little while. They had gained a lot of steam on the way up, but it looks like with so many other competitors, every company has their own streaming platform now and all putting out their own content, some unique content, some is sort of rehashed. But I believe that the more this happens, when you got Disney and you got Netflix and you got Peacock and whatever, all these different ones that are out there, and that really sort of dilutes the pool of what's going on. People, they don't need 3 different streaming services. Maybe we could have just one. Maybe they're gonna flip around, see what they like on this and that. But I think that when you look at this, we have to understand something called the blue ocean strategy, and where Netflix truly was groundbreaking previously, I don't think that's the case anymore, at least in the whole business model. If you look up, there's a book, definitely should check it out for any entrepreneur. It's Blue Ocean Strategy, and I think it would be interesting to you. Quick note here, retail investors bought low, now GameStop is selling high. The video game retailer announced plans to sell up to 3.5 million shares of the most discussed stock in 2021, promoting a dip in its price on Monday. So we'll see what happens with retail buyers if they try and jump in. But certainly much of the euphoria that was there previously has started to wane somewhat, but I'm not sure whether the longer term goals here will be achieved. We'll see. And to finish off the video, crypto market cap surges to a record $2 trillion. Bitcoin's at $1.1 trillion. So just to see the amount of money that's going here, obviously, some of it has to do with the, this newfound attention from the financial companies getting their hands on this. And so we'll see how that has an impact on when there is a dip coming around, a big dip, a correction, whether or not they will be in and out, whether or not they're just going to simply hold. A lot of these companies, they hold their cryptocurrencies and then they offer a fund to their the people who want to purchase from them. That's kind of where it's going. So they may just hold on and they don't care necessarily what happens to the fluctuations. And so we'll see how that trend continues. ETFs are starting to happen in Canada and other places, I believe. And so it's going to get approved by the SEC in the US most likely. So that's going to bring further and further attention to this particular relatively new asset class, if you want to call it that. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you want to learn about e-commerce for free, you can do that, the AmazonGPS.com. Have you seen these two books? If not, come on, you got to check it out. These are everything that you need for that foundation of knowledge. Click on the link in the description. Have you seen my video yet from yesterday? If not, you definitely want to check it out. Click it, and I'll see you there.